I think my slides are coming up. And what I'm hoping to do, though, really, is I come to you as a practitioner, someone that's been in the field for, as said, 10 years, but the organization I represent, 25, simply trying to move money from the capital markets, from investors, from pension funds, from institutions, from individuals into communities around the globe. And so I have one hand in the capital markets and one hand in communities. And from that lens, I've been witnessing how money moves, where it gets stuck, and how we can all work together to create the world that we're looking to create. And with that, I wanted to share this morning some frameworks of how that money moves, so then we can go on and we can talk and we can network and really do the work. I really commend Chairman, who you've brought to this room today, and the whole team at IIF. It is the right people in the room to do this work, to open the markets so it can include organizations and communities that right now are not being able to access finance from traditional resources, from banks, from the capital markets. It takes everyone. It takes the private sector, it takes the public sector, and it takes the philanthropic sector. So to have everyone in the room today, that is an auspicious start to what I know will be a really productive and a really great journey. Moving to the next slide, as the governor indicated, what we see is a great opportunity. As I mentioned, the work we do at Calvert Impact Capital is providing finance. We provide capital to communities, to organizations, to funds, to intermediaries that are left behind by the traditional markets. They are left behind simply because what we've seen, the traditional markets don't understand them. They're different, so they perceive them as risky, where what we see is opportunity. These are investments in communities, in healthcare, in affordable housing, in education, as the governor mentioned, that are extremely financeable, but they just look different to what the markets understand today. And so with that, what we see is truly an opportunity, a $6 trillion opportunity that, as was mentioned, the global giving, the money that development finance institutions, the money that philanthropy puts towards these, and even the public sector does not have the resources to match. What we see, and you see on this bar to the left of this slide, is the wealth that sits in the capital markets. This is just a fraction of it, the 78 trillion. These are the assets that are globally managed by the top 25 asset management firms. If you look at the totality of the capital markets, it's $270 trillion. To move that money into community is the goal. So how do we do that? Moving to the next slide. What we have seen is there exist two levels of intermediation that helps money move out of the capital markets into communities. What you see here in this framework is on the left, there's a set of groups, capital raising intermediaries. They're solving for investors' needs. Investors' needs around liquidity, around risk and return, around volume and diversification. And I'll explain a bit more what that means. On the right, what we see is capital deployment intermediaries. These are funds, these are nonprofit organizations. They're intermediaries that are working close to communities, and they're solving for capital needs, customizing the capital needs for the market that they're investing in. They're giving technical assistance, ensuring that those communities, those projects are ready for capital. What we've witnessed is we need both of these levels of intermediation to successfully unlock the private capital, the $270 trillion I mentioned before that sits in the capital markets, to get it into communities. One of the strategies to unlock that capital that's happening in that blue and yellow area is blended finance. Blended finance is simply taking catalytic capital, generally provided by philanthropy or public resources, development financial institutions, and using that money to bring the private sector to the table, to bring their capital on and invest it into something new or different. It does that because it de-risks the investment opportunity. Investors in the capital markets may perceive that the investment opportunity over here in the global community is too risky. It's different. I don't understand it. That's their perceived risk. However, many of us, perhaps, that sit in these orange bubbles that are closer to community or in the community themselves, sees that it doesn't carry a lot of risk, that the real risk of that investment perhaps is a lot lower. So to bring the perceived and the real risk together, we use the strategy of blended finance. As a footnote, most of the capital right now coming into what this sometimes people call the impact investing field is coming up through the capital deployment intermediaries. It's coming straight in from development finance institutions, from philanthropic partners, from high net worth individuals, being blended and then brought into communities. If people are familiar with the Global Impact Investing Network, it's a trade group that holds the impact investing community together, a fantastic resource of studies, of networking. They estimate that the size of money moving into these orange dots is about $500 million. So you can see we're even on a global platform, we're still falling short of that $6 trillion goal that we need to really achieve a sustainable and equitable world by 2030. What we're working towards is continuing to unlock this capital markets, continuing to create more track record, more proof that investments in community are financeable and bring them closer to the capital markets. So how do we do that? Next slide, please. How do we evolve the global communities so we can bring them closer to these commercial private capital markets? So we can bring them closer to potentially the banks, to the capital markets, where they can access scale capital and really then find the amount of capital needed to address some of the challenges around education, health, and housing. What we've seen is we need everyone at the table: donors, private capital, and public. Here you can see the evolution as we've seen it happen as sectors mature from a donor-driven market to, if they can, accessing capital from the private markets. What we see that bridges much of this is the blending of capital in the middle. From experience, what we've seen is this blending stage is quite big. The gap between the blending philanthropic private capital and getting to commercial markets is a big one. And so oftentimes it's not one blended finance deal or transaction or strategy, but it takes time. It takes multiple time, strategies, vehicles to move a market into the commercial environment. We've seen this happen in the microfinance industry, if people are familiar with that, an industry that started 30 years ago in earnest, enabling lower income individuals to access capital, to be included in the financial system. When that field began, there was great skepticism that the poor could lend, you could lend to, and that they would return the money with interest. What we've seen over time is performance, that indeed there is the capacity for that group of people to take money, use it, build wealth, return principal and interest. And what we've seen is as a field it has scaled, where today many of the top tier microfinance institutions are accessing the commercial markets, growing and scaling to really meet the needs in communities. What we've also seen, frankly, is not every social challenge that we have can meet the commercial markets. There is some sectors that potentially will always need subsidy. They'll always need public support. They'll always need the support of philanthropy. But what you see down here is the roles that we all play. And one of the things that we've found in the work that we've done at Calvert Impact Capital that's very important to understand what role you play and then play that well. Next slide, please. As well as playing the role, we've also observed blended finance is both an art and a science. So there's no ironclad rules about how to build a finance vehicle, who should be doing what, and how they should be doing it. But what we have observed is some lessons that seem to come up time and time again. 3 that I'd like to share with you today. The first is to be honest. We were part of a transaction that I mentioned here on this slide. It was a first blue bond ever. The government of the Seychelles issued government paper, and those proceeds were to fund a new blue economy. It was a very exciting moment about 2 years ago and got a lot of press. However, what I don't think was really publicized enough is all that happened before that. To build the right ecosystem environment for the government of the Seychelles to be able to issue that paper and have a financing vehicle that was investable took about 3 to 5 years and $25 million of philanthropy and Development Finance Institute resources. So as you think back to the slide prior, as we build markets, the financing piece is exciting, and it does happen, but a lot must happen before. And we need to be honest about the resources we need from the public, from philanthropy, to really build the ecosystem, the enabling environment that can bring finance in. Second lesson, next slide, please. Another transaction that we were part of, a fund here across the African continent, the Medical Credit Fund. Some people might be familiar with it. They're a fund dedicated to advancing rural community health care clinics, providing financing so that communities can upgrade those facilities and also purchase equipment. This fund was built, capitalized, and ready to go invest. They went into the market and they realized 2 things: that not every clinic was ready for capital, that there was a need for more technical assistance to get these clinics really optimized to take on debt or equity to build out their capital needs. They also found that a lot of advancements can be made just in getting operations more advanced within the existing facility. One example that resonates with me deeply in this is they went into one healthcare clinic and they found in the theater that there was no intercom system, that people were moving in and out of the operating theater to communicate with people outside for equipment, for updates to family. They learned if they just had installed speakers across the theater and other rooms that they could create efficiencies, save a lot of time, increase the outcomes for the patients in a positive way, and also see more patients. So before even buying more equipment, building onto the current facility, they can make advancements in that present facility to really advance what they already had. But that required more technical assistance and grant money, not financing capital. So they needed to iterate. They needed to go back to the funders, to those people that had given them the capital, and explain that the market needed different resources than they had seen initially, and then go from there. On the other side of the equation, they had a vision, I think one that is really strong and very possible still to execute, but the market wasn't ready for yet again. They saw the ability to go and raise capital in this fund, invest that in the clinic alongside of local banks. So they would be half of the investment capital, the bank would be the other half of the investment capital. When they took their first deals to the banks, they realized the banks weren't ready to talk about healthcare clinics. They didn't understand those business models. They didn't have the operating infrastructure to underwrite them, to invest in them, and to monitor and manage that type of investment. They had to step back and take time to train the banks about that type of investment asset and bring them along with them. Iterate is another lesson we have learned. The last is integrate. As I mentioned, to make these transactions work, what we've seen is you need everyone around the table, the public, the private, and the philanthropic sector. What we've seen time and time again is these blended finance vehicles get built with 2 of the 3 parties at the table. The cake is getting baked without all the ingredients. We have seen that what works better is to bring everyone around the table at the beginning, to see what people need from the transaction to meet their own needs, as well to advance the impact goals that everyone's sharing. And then we can move forward in a way that's a lot more efficient and smooth. Some final thoughts as I leave you for the day is simply there's been a lot of work done around impact investing and blended finance. As I mentioned, there's no ironclad rules. There's a lot of creativity. There's a lot of customization to ensure the transaction meets the community needs. But there's also a lot of templates. There's also a lot of deals that have been done. And I would encourage all of us to network, to talk to those who have done the work, leverage what is out there, bring it in. Don't start from the bottom floor. Don't recreate the wheel. I have found that this community is one that really wants to share and to see everyone succeed, because when we succeed, the whole world succeeds. With that, I wish you a wonderful day, plenty of networking, and productive outcomes. Thank you very much.